Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss the Fed meeting that is currently going on, Amazon's finally maybe found a bottom, and more.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity of Dips, and Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Wednesday, May the 4th, day before Cinco de Mayo. And seems like Monday was a rough one for SPY. Went down to around 404. Did you think it was going to hit that below 400? I mean, when you said 385, I actually bought some 385 puts. And funny enough, they were up 80% that day, so got rid of them there. But yeah, what did you think about Monday's action and then obviously Tuesday's bounce back? Because it didn't look like it was gonna be, as hard of a bounce as there was.
Yeah. So I didn't. Let me see. So the first off, the bounce back was wild. I think we all kind of expected some kind of bounce back. However, I definitely didn't expect that tough of a rebound, especially into FOMC, which makes me think that potentially they kill it after FOMC. Or again, this could be just one massive trap.
Now again for the new listeners, let's go over FOMC.
Yeah, so the Fed, our boys at the Fed who act independently, act as a balancing act for basically the economy. So when the economy is weak, they stimulate the economy. And when the economy is doing terrible, did I say those in verse? When the economy is weak, they step up and strengthen the economy. When the economy is super strong, they basically tighten it a little bit by raising interest rates and slowing down growth. And I don't want to say slowing down growth. I'll just say more like controlling growth, so that we don't see like hyper growth and think of it like a stock. Yeah, the RSI goes to like 90. So that's the job of the Fed, and so they meet pretty often. And typically, when the Fed meets, it's not like everybody from home sits down and watches it like the Super Bowl. However, that's what it's been feeling like. It really feels like everybody's been on edge about this thing. And so when we think about that, there is a big impact that they play, especially because right now they're inside a pretty tough spot. Everybody was given, when I say everybody, I say most Americans were given stimulus checks.
Yeah, around $3,000 in total.
Yeah, around $3,000. And so what that did was that what that did was that that boosted the economy, but that sent us into inflation that we haven't seen in 40 years. And so the issue with that is that they have to control inflation but they also have to try and keep up the economy, because typically when you tighten the economy and you raise interest rates, you want to raise them because the economy's strong. We're not really that strong of an economy right now, and so right now it's a balancing act, because again, you're trying to keep up a weak economy, but you also have no choice but other than to raise interest rates because inflation is at 40-year highs. I think year over year, inflation was at 8.5%. So that means that if you just took your money and put it inside your mattress, you are down 8.5%. That's a lot of money to just be down for absolutely nothing. So I think that's an important way to look at it. Like, a lot of people say like, oh, like inflation, like, you know, like I see the difference between milk. I see the difference between gas. I see the difference between this. Well, the other thing is that your dollar's worth less.
It was 9 cents cheaper for Thanksgiving dinner. So
that's true. That's true. So I guess it all evens out, right?
Yeah.
So with that being said, you know, that's something to really keep an eye on, because one of the things that ends up happening when you raise interest rates and what we see is tightening is that typically the market cracks. And what I mean by cracks is that I'll read a tweet from Macro Alpha, his name is on Twitter. And so he says, before tomorrow's Fed meeting, good to provide some context. Peak in Fed funds rates before the, quote, something breaks moment. For 2006, it was 6.5%, 2008, 5.25%, 2018, 2.5%, and obviously now we're at 2002. And basically, I mean, if you look at that, every single time that the Fed has had to raise rates like this, you're seeing a similar trend. You know, again, I'll say it again. 2000 was 6.5%. 2008 was 5.25%. 2018 was 2.5%. Those are pretty drastic declines before, you know, the market started to really take a hit. And so with that being said, you know, tomorrow could be big for a multitude of reasons, but one of the biggest ones being that, you know, if let's just say we have to raise 100 basis points, I mean, that could send the market through 400, no problem.
Do you think this one's more scary than the last one? I mean, we made it out the last one and turned out to be bullish, even though everyone was so scared of it. What do you think about this one compared to the last one?
We're not out of the woods until inflation really starts to come down. Once we see inflation below like 6.5%, that's when it's kind of like, okay, we're starting to like correct this thing. But until that happens, the Fed is going to be forced to, I mean, the exact words that I bet they'll use are, we are forced to use the tools in our tool belt to accurately, or, you know, something along the lines of to accurately and sustain the market, or, you know, the economy, and you know, something in that way. And they're gonna have to raise rates. So I really think that every single one is kind of scary until we get out of it, because again, it's really hard to be bullish on the market right now. I mean, it's really hard. I mean, like, when think about it, what can you be bullish on the market right now? No, anything like off the top of your head?
Inflation going away.
Yeah, inflation going away. So the 8.5% inflation, almost double-digit inflation going down. Another stat that I think is really interesting is that 22% of NASDAQ companies, 22% of NASDAQ companies are down 70% more this year. 70%.
It's a lot.
Yeah, like that's you know, I mean, 1 out of every 5 companies is just down 70% or more inside the NAS. And that's just this year. It's May 3rd. I mean, at that rate, I mean, we'll see just absolute carnage. So I think it's really important to realize that, like, right now, if you haven't made many moves this year, like inside the market, that's totally okay. I don't think it's that big of a deal. Because again, like, we really have just seen things get absolutely slaughtered inside the past 5 months. And I mean, more probably comes. And so tomorrow will tell a lot, especially because I don't really like that they're kind of holding the market up into FOMC. It feels like they want to dump it after. Like this just feels too not, I don't want to say easy, but it just feels like, everyone's thinking the same thing. Like, oh, we got through the last one. Now this one, let's raise 25, 50 basis points and move on. And I don't think that's necessarily the case. Maybe it is, but I don't know. That feels like maybe it's too easy.
I think going back to like the too easy thing, before we were talking about the Fed getting back into SPY, bouncing that 3% from what was almost like a detrimental Monday.
Yeah, exactly. It was a super detrimental Monday, and then you had like that V recovery. And the other thing is that you're not seeing tons of volume on SPY, which also makes me kind of think like this is kind of like a low volume bounce, which is the other reason that like I'm pretty cautious going into FOMC. Like it won't take much to the downside to cut through. And again, if we cut through that bottom support, that's when it's like we could waterfall down into the 395s, 390s. And so for me personally, like I have puts on right now. I think I'm down. I think I'm like break even right now. I'll probably hold those through FOMC. And if I see something super bullish, then I'll just cover them for a small loss. Like I'll take that kind of risk to reward. Like it's not really like I don't want to say that I don't have a reason to be short, but it's one of those things where I see the risk to reward being really good right here, especially because everybody's was looking for that bounce. And it feels like a lot of people missed the bounce, or at least like they think that this is just the beginning of a bigger bounce. Because again, SPY is only at 416. It was trading at 450 like a week and a half ago.
What is kind of the difference in, how you always say you wait for a sign of strength? If this wasn't the sign of strength you wanted, what would be the sign of strength you're looking for to finally go bullish again?
So the biggest thing is that it's been lower volume. So what I would want to see is that realistically, I would want to see it get back over the moving averages. So I'd want to see it get back over like the 9-day moving average. I'd want to see it get back over the 20-day, like stuff like that. Like right now, you look at SPY and the moving averages are so crisscrossed all over the place. They're kind of a mess. And right now, SPY's been rejecting most of the moving averages every time that it touches it, especially like I'm looking at like the 1 year, 1 day. The 9-day moving average was abruptly, and when I say abruptly, I mean this thing bounced off of that at 422 and 3 days later was at 405. So it's one of those things where I would definitely I want to see it get above there, base above that 9, and then go for the 20. And again, though, this is on lower volume. So any kind of volume to the downside, and we're in trouble. And we're in trouble. So I don't want to say like it's not possible. I just find it really hard to be bullish on the market right now, even though things like the war in Ukraine isn't really, I don't want to say it's not a thing, but it's not affecting the market like it really was. So that's pretty good. But something like Apple earnings should have bounced the market. And so it still feels like every pop is kind of being sold, except this one as of late. And again, this one's on lower volume. So it feels like they're getting ready to kill it. However, I'll gladly eat my words if we're sitting above 430, above that 9 EMA on Sunday. I'll be super happy to be up there. And we have good volume. We get above there, we base. I will be ecstatic. And then, so last thing but before we moved on, I did want to read you something that I found out this week.
Hit me.
And because I think that this is important. This kind of goes back to what we talked about the NASDAQ and other things. Because and the thing that we always talk about, which is stock picking is a loser's game. This is from Wikipedia. It's on the .com bubble, And so underneath the dot-com bubble, underneath Aftermath, it says, after venture capital was no longer available, the operational mentality of executives and investors completely changed. A dot-com company's lifespan was measured by its burn rate, the rate at which it spent its existing capital. Many dot-com companies ran out of capital and went through liquidation. Supporting industries such as advertising and shipping scaled back their operations as demand for services fell. Now, this is the important part. However, many companies were able to endure the crash. 48% of dot-com companies survived through 2004.
That is surprising. I feel like most of them were like bullshit.
Yeah, but it's like we're calling it a win because 48% of the companies lasted through the crash. Like, that's really not like I don't think that's really something to be like patting ourselves on the back as like a win. Like, hey, congratulations. 48% made it through. That doesn't seem like a big win to me. So I think it's interesting when people always say like, hey, Hugh, like, how much lower can this thing go? I mean, this thing can go to zero. And again, we look at the dot-com bubble, more than half did. Like more than half just, got liquidated. They were sold. They were acquired for pennies on the dollar. So don't think that like these things can't go lower. The other thing is that and this is just something that caught my eye, by the end of the stock market downturn of 2002, stocks had lost $5 trillion in market cap since the peak. As its throw on October 9, 2002, the NASDAQ 100 had dropped to 1,114, down 78% from its peak. Do you know what the NAS is at right now?
Fucking riddle me that one.
12,500. This bitch went down to 1,100. It's at 12,000. So it's 12 times higher than where it was 20 years ago. Okay, fine. So you say, okay, fine. But even 5 years ago, May 26, 2017, this thing was at 6,200. So even though the NASDAQ has gotten absolutely smashed this year, it's still up 100% in the past 5 years. An index.
And your what would you say your heart says about that? Your heart had a few words.
It'd be like, hey, yo, stop buying every fucking dip. Respectfully. I get so many messages about, hey, Hugh, like the NASDAQ's down. What are they down inside the past 6 months? 21%. That's a crash. Yes, it is. But you know what it was up last year? You know what it was up like the last 5 years? It's still up 100%. From 2017 to its peak, that was like 260%. That's an index, not a speculative investment, not Tesla, not some bullshit, an index, the NASDAQ 100, the composite. So let's not get all fucking nutso about this and think that we can't go lower, because we totally fucking can. I mean, I'm looking at the NASDAQ right now, and I mean, realistically, support is probably like another 1,000 points below. Like, that's another 10%, minimum 12%. So let's fucking relax about buying all the dips and just chill. Like, when the time comes to buy the dip, and the companies will stick out like sore thumbs. I promise. Like, you're gonna see deals on deals on deals, and this is where I got laughed at last year because I still said that fundamental analysis would still be important. I'm telling you right now, fundamental analysis will be your friend in 12 to 16 months if things continue the way that they are. Because again, SPY's still at 416. Like, we're only 60 points off highs. Everything's being held up. Like big tech is still, holding everything up. Apple's still at 160. And so like let's not get carried away with like buying the dip when like the potential real downside hasn't even come. Again, remember, even if something's down 60%, it can still be cut in half again. That's my little rant. Let's not go. Listen, look at the NASDAQ. Print that out. Print out the 5-year chart on it.
All right. Well, speaking of things down 1,000 points, you want to talk a little bit about Amazon. We talked about it as it was dropping. It dropped a lot. It bombed at what, like 2,300, like $1,000 lower than what it was before the earnings report. Was the earnings report that bad? I mean, I know you said you'd probably start picking some up around that 2,350, whatever, thinking that 2,200 could be the bottom. Well, I mean, if you did, you picked it up at what seems to be the bottom or its first bottom. So what do you think about it? Where do you think it continues? And are you buying some this after hours?
Yeah. So I like where it's at right now. It's consolidating. This was so first off, Amazon is 100%. I'm waiting to buy it till it's till May 27th, because that's the day that that you have to be a shareholder by to participate in the split. So I'm waiting till then. However, I'm 100% bullish at this 24.85 mark. Inside my Roth, I have shares from 999. I love Amazon. I think that they're the goats, if you will. Listen, this earnings report, they still grew. Like they still beat earnings expectations. However, that Rivian loss smoked them for billions. Okay? So if anything, this is your dip on Amazon, in my opinion. This is the perfect time for this to happen to this company. Because again, people are going to be buying for the split, which happens to be 3.5 weeks away. Like, one of the best things, I don't want to say the best things that happens to companies, but one of the more bullish things that happens for companies is only 3 weeks away. So with that being said, I think that this is a buy here. I like it. It can even, like, I would even be okay with, like, let's just say that you want to throw 5% of your portfolio in it at here. I'm okay with that. Or like you want to work your way up to 5%. I'm okay with you putting in 3% here, and then if we see like 2,000 putting in another 3%, like I'm okay with that, because again, the split is going to happen, and so when that happens, there's going to be an influx of buyers.
You'll have more Amazon shares than you ever thought you would. Yeah,
that's true. And so I'm okay with you buying it here underneath this 2,500 level, let's just call it. I'm okay. I think that's a buy. And just leave a little bit of room to add in and hold it for 20, 30 years again. Because the difference, this is one of the only companies I'm okay with you individually stock picking. Because again, this company, Apple, they have so much money, they have so much resources, they have their hand in everything that it's something that we've never really seen before. Like, GE was the Amazon of the 50s, and GE couldn't at its best can't even light a candle to Amazon, obviously. So I'm okay with you buying here. They're going to continue to innovate, I think, get into other areas. They are the top dog of, they have AWS. That's where a lot of their focus has been. And so I'm okay with, because I look at Amazon as more of a holding company than anything. And again, at the very minimum, their e-commerce and, they're like, they account for like 50% of shopping at this point or something.
Fucking everything. Yeah. No, I think they're big dogs, and I think they are here to stay. I think that'd be fair to say.
Definitely. I think that's totally accurate.
All right. Well, coming into the rest of this week, obviously we have the Fed meeting and everything coming up, and you talked about playing the put side. For the newer traders, are you suggesting sitting out, playing abnormally small, or what two price ranges? I know you mentioned 430 and 390. Are you kind of, as a newer trader, would you wait to see those before making any like sudden moves.
Yeah. If you wanna take a little, I'm gonna literally call it a gamble. You want to take a little gamble into FOMC because I'm expecting some volatility. I'm okay with that. However, with that being said, understand that if you're wrong, you're gonna get your ass smoked. So I'm okay with you taking a little bit of a gamble because I do expect there to be some volatility. However, just treat it like a true lotto. Like that's the only way to do this. Like have your finger on the trigger so that if you see like a green Hulk or you see like a knife, a blood knife that, you can get out with some damage. And again, it should be like don't risk more than like 0.5% of your account. Like that's how much you should risk. Like don't risk any more than that. And again, if it works out and you do okay, then you'll make you'll probably make a good buck. And if it doesn't, then fine. Then at most maybe you lost like a day's worth of gains or something. And so I'm okay with that.
All right. So going back to what we were talking about earlier, where you said, what could we possibly be bullish on right now? I think you ranking the things that you are most scared about to be bearish for the market, and then some crazy shit that could be bullish for the market, whether cure for cancer, world peace, whatever it might be, that is going to save the market from disarray.
Yeah, so like I was saying, I it's hard to be bullish right now because it really doesn't feel like there's anything to be bullish on. Tech earnings felt like the thing to save. If tech earnings felt like the thing to save, the market and things of that, the market and everything else, and that's just not what happened. I think everybody was expecting like tech to have blowout earnings and to come and save the market and the market to get a real big bounce back, and that just wasn't the reality. So now, what do we really have to be bullish on? I really can't think of too much. Like maybe we don't raise interest rates. Like let's just say that tomorrow we don't raise interest rates. Well, then we go into the, interest rates are already up to 5%. So at that point, it's kind of like, at that point, it's like, all right, like, interest rates are still up double inside the past 6 weeks. Like that really doesn't do much for me. So, I don't know. Like at that point, like we might as well just skin this cat. Raise interest rates to the, send them to the gulag, send interest rates to like 8-9%, get it over with. Let's push inflation down and, kind of like be aggressive with it. And then we can pick up the pieces once inflation's lower, because that's the thing. Okay. Remember is that the Fed is supposed to act as a balancing act. But again, when the balancing act is the Fed has to keep up the market or, keep up the economy, and hold the economy up, but also fight inflation. That's where it's like, double-edged sword. You're damned if you do, you're damned if you don't. So in my opinion, I don't think there's too much to be bullish on. In this regards, I think that you can be short-term bullish, but I think until inflation is lowered, I don't see much reason to be bullish. You can be bullish on big drawdowns. So similar to like when the market just got smoked from like 420 to 405, things like that. You can be bullish on that. Like you can scale in and take that ride up because that was a pretty good V recovery. But overall, I wouldn't be like accumulating individual stocks necessarily, like a firm or anything, or like I wouldn't be doing that here, just because again I don't see much reason to be bullish. And the other thing that I think is really interesting is that I keep seeing people talk about the housing market, and I think it's really important to know is that something that we've never really seen before is that we've seen these hedge funds really buying up tons of real estate. BlackRock owns about $60 billion in real estate assets, and the value of the housing market in the United States is like $36 trillion. So when you say it like that, it doesn't really feel like a big number. However, when I say this number by Bloomberg, more than half of the country's multifamily properties are owned by institutional investors compared to an estimated 2 to 3% of single family rentals, a gap that this analyst expects to narrow in time. And so one of the issues with that is that not only does it make like big corporations too big to fail, but if these hedge funds get smoked in a few quarters, then, and they have to sell something, then they're going to have to sell real estate. And again, it comes down to simple supply and demand. If they have to sell their real estate, and they need to basically think of it like a margin call, they got to get these numbers in. If you got to recall, 10 billion in housing and 10 billion floods the market, even though it's $1 trillion market, 10 billion flooding the market is still going to do something to it, and it's still going to hurt it. So everybody that's like kind of flocking to real estate, the one thing that I would keep in mind is that real estate for the first time is more heavily entangled than I think people realize. And I think that's just important to note before like going all in on real estate and waiting for quote unquote stocks to relax. So I think like that's kind of my final note on that. And then again is that zoom out on some of your favorite stocks that you really want to accumulate, and remember that they can go lower. So everybody's saying that like the NASDAQ is down 22%. Just remember, it's still up 100% in 5 years.
All right, guys. Well, I hope whatever the fuck he was talking about this episode really residuated, or I'm not sure if that was the right word. I'm sure Hugh could tell you if it is. Really resided with you guys a lot. And we will see you next week. Good luck with the Fed. And we'll see if Hugh's right. Hugh, you're buying Amazon during the after hours or no?
Yeah, I'm going to buy a share right now.
Oh, one share.
As we speak.
He's back,
Yeah, one
boys.
share.
He's back.
Yeah, that's right.
All right.
I am.
Well, guys, we will talk to you all on Sunday. Take care.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.